So welcome everybody. A lot of you guys already know. For the people that I don't know, hopefully able to know you soon. This is the Multifamily Passive Cash Flow for Life Meetup. We meet, when we used to meet in person, the fourth Wednesday of every month at the Timbuktu restaurant outside of Columbia, Maryland. Obviously, when COVID hit, we went virtual, and we've been doing these virtually, I think, since April. Due obviously to COVID, and we're hoping to go back to live at Timbuktu over the next couple of months, depending on what the situation is with COVID. But we've been doing this for a long time, a couple of years, and I think there's about 15 or 1,600 people that have decided there was some value here and either watch us live, come to the Timbuktu, or watch the replay afterwards. So my name is James Wright. I'm going to be your host tonight, and this meetup is all about apartment buildings, mobile home parks, and self-storage. Every fourth Wednesday, and obviously today we're doing it on a different day because we had the outage, so we're doing it on a different day. But usually it's the fourth Wednesday of every month, and we bring in a speaker to do a presentation on a subject we think would add value to you guys to help you with your multifamily careers. And my partner Nicole, that unfortunately was on last time but was not able to get on this time. She's been investing in multifamily for about 25 years now, and has several thousand apartments all across the United States. She also teaches. Actually ended up taking her class about 6 years ago and did really, really well with it. So if you have an interest, I'd really encourage you to go. It's all online now. It's at passivecashflowforlife.com. It's a phenomenal class, probably 36 modules, over 60 videos. There's monthly calls, all sorts of great stuff. So if you have an interest, go check it out. And then a couple of housekeeping notes. We'll be doing questions and answers as we go through. If you have a question, I think we've got a small enough crowd that why don't you put it into the chat, and then when Amit takes a breath, I'll try and jump in and ask your question. And if you don't get it answered during these 45 minutes or so, then we'll have questions and answers at the end as well. As I mentioned, we're going to be playing this on our YouTube channel. We'll also post it on Facebook after we're done. Give me about till Monday to actually edit it and actually put it up there. So over the last 18 months, everything's changed with multifamily, including financing. And Amit Kakar, who is the director with JLL, which is a world leader in real estate services, was kind enough to take his time and come and speak to us about multifamily financing in the COVID world, in the pre-COVID world, and the post-COVID world. So I'm going to go ahead and Amit, I'm going to let you introduce yourself.
Awesome. James, thank you for the opportunity. Yeah, keep it informal. So, if there are questions, feel free to just stop me and shout those out. Like you said, I focus on multi-housing over here at JLL, primarily on the debt and equity side. With that being said, we do all facets of commercial real estate. So if there's self-storage or something else that's mobile home parks, which rolls up into multifamily, if there's something else that's of interest and something that we can help you with, feel free to reach out. But, there's a kind of a hybrid here of a deck, with some stuff about JLL that I'll go through quickly. But the meat and potatoes is just an update really on, what financing looks like. And James, to your point, kind of pre and post COVID, because we're starting to see some daylight here. A little bit of background on me. I graduated college in 2008. Wonderful time to graduate and enter the working world. Started working at Freddie Mac, who is one of the biggest, largest multifamily lenders in the United States, and started there on the fixed income side. So we're doing enterprise risk management, stuff like that. Switched into multifamily originations and then capital markets over the years. So kind of have a varying background, but what I'll go through here, it's a hybrid of kind of institutional, but I'm going to really try to tailor it to what may be helpful for you guys as you're looking for, deals that may be a little bit smaller. And then the other thing that I wanted to, quickly highlight is, all of this really stems from a love of multifamily. And, I got into this business, as an investor, bought a 4-unit when I was younger. And, that's something that really turned into what my career is now. And it's great because, where I started was, looking at, smaller deals. And then now in a position to try to help clients that are doing something similar. So with that kind of overview, I'll just go ahead and dive into this deck. James, like I said, feel free to stop me if there's a question or something you want me to go deeper on. Happy to do it.
Sure.
So I'm going to get this. Can everyone see my screen?
Yes.
Okay. So breeze through this quickly. Really, this just covers who JLL is. We can cover the entire capital stack. My focus is multi-housing, but there's a ton of different debt opportunities here, whether that be construction, fixed float, bridge. So really, if there's any questions there on what we can do, let me know. But more so, want to focus on kind of how we look at multi-housing. Specifically, if you think about capital markets, that's really focused on debt and equity. If you drill further into, what multi-housing, how we kind of think about it from like a capital markets perspective, the chart in the right corner is really, all the nodes that kind of roll up into what we think about when we think about multi-housing.
Hey, Amit, I'm still on your first page.
Okay.
There you go.
Can you see that?
Yep.
All right. Sorry, I'm always doing Teams, so this is like my Zoom crash course. But so, as I was saying, this right corner here, it's just a kind of good overview of how we think about multi-housing from a capital markets perspective. Really, that's all I really want to call out on this slide, because if you think about it, Freddie, Fannie, who we'll go deeper into, FHA, similar, related to government-sponsored enterprise. Affordable housing, which is a node in which there's some sort of deed-restricted affordability component to the deal. Market rate, which is where I spend most of my time. Student housing, if that's of interest, falls under multi-housing. But if you think about it, it's stuff that's dedicated to students, rent by the bed, stuff like that. And then seniors housing, which is kind of, if you think about it, it stems from age restricted, where there's some sort of component of, hey, it's 55, 63 plus. Then you also have, age, you have assisted living, independent living, and, you go up to scale. I think for purposes of kind of this presentation, we'll focus more so on updates as it relates to market rate multifamily. But if there's questions on, some of the other stuff, feel free to stop me, let me know. These slides kind of just go through, our rankings. And then here, I sit in DC. James, is everyone here generally in the DMV, or is this?
Sometimes they're from out of town, but most of them are local. Yes, DMV.
Okay, awesome. So we work up and down the East Coast. With that being said, if you're looking at other markets, it's a national firm. So if there's questions or things that are in different markets, by all means, happy to help you with that as well. You can see how we're set up here. As I said, I sit in DC, but really work up and down the coast. Came from Freddie and work a ton in Florida, work a ton in Atlanta, Charlotte, and DC, and I'm starting to move up the coast. So if there's questions or things about other markets, happy to drill into that for you as well. Kind of breezing through these first floor slides, because they're really, JLL focused, but really this is a look about how we think about the asset life cycle. So capital markets being one note of that. I think it's interesting that, JLL can really look at all these different things, property management. Also, if there's valuation, that's appraisals, all these different things that kind of roll up under what you'd be doing if you're buying, refinancing, developing, a commercial product. That's kind of just talking about what we can do there. Any questions on the kind of the overview? I don't want to spend a ton of time on that. Happy to delve into it further, but really want to just focus on the rest. Anything?
So just a quick call out on my end. This is the first slide I've ever seen that talks about the life cycle that actually has tenant retention in it. Our biggest cost is turns. So we're a little bit different than a lot of companies. We will actually spend a ton of time on tenant retention.
Sure.
Not so much let's get somebody out the door because they didn't pay their rent, but really rewarding the people that pay on time, doing anniversary gifts, making sure that we turn tickets within 24 hours. And it's amazing how much more money you make if you focus quite a bit after you go through the rest of the stack on tenant retention. So that's just a call out. Thanks so much for putting that in there. I think that's
Well,
great.
and that's a great point, because if you think about it, and it's great to hear you say that, because that's really the longer lens type of focus from an investor, right? Because if you're getting in and out of a deal, there may not be as much of a focus on that. And anecdotally, what I'd say is, with COVID, right, that introduced another layer here. And so what was interesting to see from like an institutional level is folks starting to offer incentives to pay your rent on time, 2%, 3% rebate. As James, similar to your point, it's a way to retain the tenant. And then if you think about some of the Class B, Class C type multi, it's property condition. That's the big thing, especially if you're buying a deal and you're looking at something that it has been owned by the same owner for a long time, or has a ton of deferred maintenance. Those are the type of things that when you think about instituting your business plan, your value add to the property, I think that tenant retention piece gets lost in it. And then I'd also say, because we are touching all the nodes of capital markets or commercial real estate, if you think about office and some of these other type of commercial real estate investments, that's even more important. When you have 5 tenants in your office building, that retention piece is huge.
I have a question / comment about tenant retention on a value add. A lot of times you're coming in, renovating, pushing rents up. What percentage are you planning on? Is it typical to keep for tenant? Then tenant retention kind of gets lost if you're pushing the rents up like $300-400 a month. So, how does that figure in?
Yeah, no, it's a great point. I think it really depends on what the business plan is, what's that uplift, and then, what is the market support too, right? Because, a lot of times if you're spending that capital, right, you want to see a return on your investment. And so if you're penciling something that's a lot higher than what the market could support, that's where that ROI isn't there. And then, to the point on retention, right, if you're making the place nicer, you got to incentivize the tenants still, because they are seeing that rental increase. And so I think it's a balancing act there. But that's a great point. What else? All right, I'm going to go on to this next slide. Try to spend a little more time here, because this is where I spend my day. What I'll try to do here, because if you think about those past 3 slides, there's a ton of different financing options, especially if you think about construction and all these different things. I think for purposes of your first couple deals, or if you're looking at stuff that's 20 units, 5 to 50 units, these are kind of your bread and butter lenders. And so what I want to quickly do is just highlight, kind of going left to right here, Freddie, Fannie, HUD. That's thinking about conventional. And so that space is typically $6 million and above from a loan amount perspective. That being said, they can go lower. But this is kind of your traditional multi-family type of financing. What it's for, though, is stabilized assets. And so Freddie, Fannie, because they have a government-sponsored charter, they're lending on things that are stabilized. There's no huge lift that's going to destabilize the property because they're securitizing. It's really something where it's a cash flowing deal. So if you think about deals that really pencil these days, it's more Class B type real estate. JLL is one of the tapped in lenders to this network. There is a list, and what's cool about us is we have Freddie, Fannie, and we have a HUD team. for those of you thinking about kind of what this looks like as you continue to grow, I'd say anecdotally, what's great is HUD, especially if it's something where you're looking for a long-term hold, 35-year type paper, really focused on affordable type projects. With that being said, you can finance anything in the multi-space. What's interesting about this kind of first column is this is unique to the multifamily space. It's not something that you see. And if you think about, hotels, retail, office, none of that has a government sponsored enterprise that kind of is helping with the liquidity in the market. So it's a great option. If you can qualify, they offer fixed and float, various terms, here 55 to 80% being the max LTV for your more core type markets. I would say the DC metro area falls into that at max leverage. And then, what it really does is enable you to have, stabilized type financing. Like I said, do a ton in this space with our team. And that's, where we, I started my career at Freddie. So have that relationship. It's really what you're thinking about when you have 6 million and above. If you're below that, you can still kind of take it to them, but it isn't as efficient on the pricing. Just throwing out, anecdotal numbers here. I think you're above 6 million type debt is probably going to pencil on a fixed rate basis for max leverage, probably right around 350 on a coupon today. If you're below that, you're going to be a little bit higher on the capital stack in terms of what it costs. Any questions on that?
So for those that don't know what a coupon is, can you explain that?
Sure. So both the agencies quote on a spread basis, a spread over an index. And so if it's a 5-year, it's over a 5-year treasury, 7-year, same, so on and so forth. And so when we talk about, that all-in coupon, it's the spread plus whatever the corresponding index is. So, that's when I say 350, it's thinking about whatever that spread over the treasury is if it's fixed. And then if it's floating, they quote stuff over SOFR, which is an index. It's replacing LIBOR. So, they offer fixed and float. Float is something that I would say is important or valuable if you're looking at a value add deal. These type of loans have prepayment penalties associated with them, especially on the fixed rate side. What's cool about the floating rate product is it's just a 1-year lockout. So what we've found is clients that have an uplift capital type plan where they see upside in the rents or whatever it may be, you're not going to get that fixed rate debt right out the gate. Maybe you're looking at a floater so that you can start to institute your capital plan, start to see the return on investment, the NOI pop, and then refinance it into fixed if that's your goal long term.
So what are you looking at in terms of rates right now for Freddie and Fannie at 6 and above?
So a 10-year, 7 and 10 typically is their bread and butter on the fixed rate side. I would say those coupons, they vary depending on the leverage. On average, right now we're seeing stuff clear, 350-ish, 325. So it's pretty efficient pricing. And then if you're, lower on the LTV spectrum, you can easily break inside 3. One of the things I think I touched on is, how this is a different market. What's cool about that is they have affordable goals because there's a relationship with the U.S. government and their regulator. And so they offer pricing discounts if your deal has affordability, and that's not deed restricted affordability. That's just based on the rent roll. So they look at average median income based on county, et cetera. And they'll say, hey, average median income is X. That corresponds to, what they think rent should be for people making, right at 100% of average median income. And then if you're below that, they offer pricing breaks. So that's unique in this market and really driven by the government relationship.
So theoretically, if I came in and I was going to get 3.5% interest, on my note, and I was affordable housing. Could I get like a quarter point off, half point off? How is it? Not?
So the way they think about it is it varies. There's a couple of things that drive it. Is one, they have goals, right? And so I think earlier on in the year, while they're not approaching those goals, you'd be more likely to get more of a discount. It's a little bit dynamic. Right. And the other thing is, in this type of market, because they're securitizing the paper, it also varies based on the term. I would say on average, a good number to kind of think about if you do have an affordable property is probably about 15 basis points.
Okay. 15 or 50?
15, 15.
Okay. I was hoping it was 50, but okay.
Only for you, James.
Thank you.
So apart from one question, so apart from funding level of 6 million requirement, what other requirements are there to get Freddie, Fannie, and HUD?
Sure. So I think the big thing is the guarantor. And so, these are non-recourse loans with the exception of, carve-outs related to if there's environmental, if there's some sort of criminality act. Other than that, non-recourse. With that being said, they require guarantors. Now, the guarantor requirements, it's kind of a sliding scale based on the loan size, but typically what it is for if it's $6 million, and this is just for the first column here. It's just typically going to be around 5 million. First column here for the agencies, so yes. Freddie, Fannie. Right. I think a good rule of thumb for if it's 6 million, think about a $5 million net worth, which you can have multiple guarantors, and then the liquidity piece is 10% of the loan amount. So that's the conventional Freddie, Fannie program. So it's a little bit high of a hurdle, but to the end of if you borrowed from banks, et cetera, it's a non-recourse loan. So, they do have these requirements. That's probably the biggest thing. And then the other thing is that they have prescriptive requirements in terms of third-party reports that you have to go get the appraisal, a property condition report, an environmental report, survey, WDI, which is an inspection wood destroying organism report. So a little bit higher on that spectrum, but the most efficient pricing I think you'll see in the multifamily space.
Okay. And what kind of property they own? They like to finance. It's only multifamily when there are so many, right?
Yeah, only multifamily and because there's, if you think about the government relationship, the focus is really stabilized multifamily. So they view that as general rule of thumb there, thinking about the affordability being 15 basis points, is they're looking for stuff that's 90 for 90 days. That's the lowest threshold from an occupancy perspective because they're securitizing this. And, if you think about that, that's an investor buying a security, which has for Freddie, a pool of mortgages. For Fannie, it's a one-off, one loan, one security relationship. So that's one of the disclosures that are in there. Any questions on that?
For stabilization, they're looking for the past 90 days before you get the loan at 90% or more occupancy. Is that correct?
Correct. That's like their minimum requirement, if you will.
Yep.
They're sizing stuff that, if you're 100% occupied, and you'll find this with any lender, they're going to be sticking some sort of vacancy factor in there. But the agencies, really focus on in-place cash flow. So you're not going to see a pro forma. You're not going to see them lending on future dollars that are not in place. Really a stabilized cash flow lender, but to the point on, the pricing and the relationship with the government, the most efficient pricing.
Okay, so they won't do the mobile home or RV parks like that, right?
So they will, but one thing that I would say there is really want to check in on the quality. So I think over call it about 5 years, I think they've expanded what that credit box was. Thinking about mobile home parks that are less transient in nature, more of like your folks are living there. You have pad sites. They really want to lend on, the higher end of the mobile home spectrum. So there has been a little bit of a pullback in that in that financing for Freddie Fannie, but they will still do it because typically, that's where you're going to find your affordable business too, if you think about it. So they're incentivized to do it. So if you can find something that qualifies, it's going to price well.
Okay.
So not to get too much into the weeds, but when you say 90% occupied, are they looking at 90% physical occupancy, or are they looking at 90% economic occupancy? Like, after the bad debt.
That I would say, it's almost both. So they look at what the physical is, but they're also trying to understand what your net rental income is. And that, James, to your point, that's where concessions, bad debt, vacancy are going to kind of be a consideration. Okay. And then, the other thing with COVID is they started also asking for accounts receivable reports, right? To understand, hey, you're booking your bad debt, right, monthly, and it's based on, write-offs, et cetera, but what's kind of aged in terms of 30, 60, 90 days, right? Because they want to understand, like, hey, what hasn't been booked. So that's been a part of the conversation, and that's really, driven by COVID and, it varying by market in terms of, impacts, et cetera.
Okay, great.
Want to go on to the next column, Freddie SBL, because I think, this is more focused, two things. It's something where there's also a relationship with Freddie and Fannie, but if you think about the first column being 6 million and above, Freddie SBL stands for small balance loans. That's where they're financing anything, not anything, but 5 to 50 units is what they're looking for, typically looking for 7-ish million and below. Not necessarily priced as efficient as that first column, but something to think about. If you're looking at a smaller deal, 5 to 50 units, that's the threshold. And the minimum loan size for this program is typically $1 million. So more so for your 20, 25 unit type properties. And then one thing to call out there, most of it walks and talks like the first column, Freddie and Fannie, but less of a requirement as it relates to net worth and liquidity. Still need a guarantor. But if you look at the bottom column there, or the bottom box, really it depends on what the loan amount is. That's what they're looking for net worth. And then liquidity is 9 months of P&I. So if you think about the loan size, less of a hurdle, if you will, relative to, Freddie Fannie conventional. Any questions? What's that?
What's a hybrid arm? What is that?
So if you think about floating for Freddie Fannie, what the small balance program does is they have like a, hey, 5, 7, 10 years fixed, and then it will float at some sort of corresponding, index and pay rate. So it's more so a product that will walk and talk more like a bank type product, because typically banks are going to want to lend 5, so 5 years, and then it's going to float over some sort of index, right. A spread over the index. So that's really what they're trying to mirror there. And it's good if you're working left to right, because if you think about a bank, and there's a little more detail on the next slide, but this is really the meat and potatoes of it is, a bank is really that's going to run the spectrum from a local, regional, community type bank to your money center banks. So we talk to the whole gambit depending on the opportunity. So really you're going to see some variability in this market if you think about it. It's all more so driven on what the collateral is, but generally it's solving to a debt yield, not a DCR, so a debt service coverage ratio. So it's saying, hey, what's the debt request relative to the NOI? And that's how you can calculate your debt yield. Really want to see stabilized debt yields, 6.5 to 8. But this is really a broad category because it's going to run your gambit of local banks who we talk to a ton, and then also your money centers, so your JP Morgan, Bank of America, those type of banks.
Okay, great, thanks.
And then the last one's debt funds. This is a little bit newer, not newer, depending on how long you've been in the business, but what I'd say over the last year, especially for multifamily, is this is a great source of capital. If you think about Freddie and Fannie for stuff where it's stabilized 90 for 90, where there's not a huge CapEx plan where you're, putting a bunch into the units in the common areas or, refilling the property or re-tenanting. This is going to run your gambit. They want to understand what your business plan is, but they will lend on, things that do have more of that lift. And so where that's valuable is two things. Multifamily, everyone's favorite right now, and has been for some time. And I think so if you think about, my world and being able to work on all these different product types, if you call someone and have a value add multifamily deal, that's going to be something that's going to get some interest relative to if you think about hotels, office, and some of these other products. And then the other thing is if you have a value add plan, let's say it's 10,000 a unit, that's a higher number, but they will lend on that. They want to understand what your 3-5 year pro forma is. So really a different lender, if you think about it, relative to your Freddie, your Fannies, who want to just understand what the in-place cash flow is. This slide does a good job of kind of bookending, really the four major categories for what we're talking about today. Your 5 to 50, upwards of 50, but the multifamily that's going to get looks from these type of lenders. Any questions or anything you want me to go in deeper there, James?
So I was just curious on the, you talked about $10,000 rehab per unit for Freddie and Fannie. If you have a 90% occupancy, but you're still going to do a value add based on market metrics and decide, I can raise the rents by, $85 if I put,
Sure.
$4,000 a unit or something like that. Is there a limit as to what that rehab can be for Fannie and Freddie until they say, no, we're not doing that?
Not necessarily. I think what you'll get questions on the business plan, right, is if you're going higher than that dollar amount, they want to understand how you're going to get how there's a path to not have it be destabilized, right? Because it's going to go into a securitization. But if you're saying, hey, it's going to stay stabilized, that's an opportunity, even if you're spending $10,000 a unit on the right now.
So from investors' perspective, what would be the ideal combination of products would you recommend? Because I think that the agency products or SBL definitely have, I think, good, nice interest rate.
Yep.
Then that can be capitalized. But others have the other use cases. But what would be the ideal situation for an investor, which you like, let's say, investor to position and kind of go for that?
And tell me if this answers it. I think what's a good test case there, or something to think about, is more so for the debt funds. A debt fund, what's efficient there is if rents are severely below market, and you see an opportunity where you have some sort of value add, that's where that could come into play, because it's going to be priced less efficiently than the Freddie and Fannie paper. One, because they know that it's got some sort of business plan where either there's an uplift on the rents, or if there's retail space, maybe the business plan is to lease up that retail space. There's several use cases for the debt funds that run the gamut, and really what's great about that market is it just comes down to price. So what are you trying to do? What's the dollar amount, and what's the business plan? And there's generally going to be a lender that would finance it. It just comes down to what that cost is. So if you think about it from an efficient, capital perspective, Freddie, Fannie, if you can get it, you want to go for that. If you can't, that's where you kind of can really run the spectrum of what's the business plan, and we can, tell you what that paper would look like from the lending community.
Okay.
How long do people usually stay in a debt fund before they refinance out?
So it's a 3-1-1 typically. That's your vanilla structure. So what that means is it's a 3-year term, and then you have 2 1-year options. typically the 1-year options, they cost. So there's a cost associated to go exercise that extension. So really what they're trying to do is nail down what's your business plan, how long is it going to take? If it's going to take 4 years, maybe they don't want to lend a 3-1-1 because 3 years down the road, you're not going to be done per se based on your pro forma. So that's, vanilla 3-1-1, but, opportunities can take you, shorter on the spectrum and then higher on the spectrum too. You can do it 18 months if you need it.
Is there a difference in being able to get a note from Fannie or Freddie if it's a brand new acquisition or it's a refi out of a debt fund? Is one easier to get than the other, or does it not matter?
So, I think they're, and I'm just thinking about COVID because that's what we've all kind of, agency space. There was a delineation for refinances and acquisitions. So if all else is equal on the deal and it's an acquisition versus a refinance, they were less aggressive on the credit parameters for the refinance. Okay. And so if you think about that, right, if you're refinancing out of a debt fund, you'd be subjected to that. Now they've relaxed that a little bit, actually a fair amount, but that's probably the most tangible thing to point to when you think about the opportunities. And then, the question really comes down to value creation, but also cash in the deal. And, 1 or 2 years out of owning a deal, especially for the agencies, they want to understand how much cash you have left in the deal. They're not going to go, 100% LTC, rarely going to go 95 LTC on something that you've owned for an LTC's loan to cost. If you've owned it for, a year or 2 years, if you've owned it for 10 years, different story, because market has moved a ton and they understand that when they think about a long-term hold. So less of a consideration.
Okay, great. Thank you.
So this just is very similar to the last slide. Just goes a little bit more into some of the pricing. Now, this stuff is moving constantly with capital markets. So I would say, James, when I did this, last week, it's probably even a little bit stale. So I would focus more on the first slide, but this is just another kind of breakout to just understand the various lender types and, what the options are. The main takeaway here, if you think about what we do, with all the various commercial real estate components, everyone wants multi, everyone wants industrial deals. So, that's gonna move you up the stack when you're comparing it to other commercial real estate asset classes.
Can you give us an idea of what the interest rates are right now for? And again, I'm I don't want you to have to nail it incredibly well, because I know it fluctuates depending on specifics. But on average, what does Freddie Fannie look like, in terms of an interest rate? What do banks look like, and what do debt funds look like?
Yeah, so maybe the best way to think about it is, because it is such a sliding scale based on inputs for these loans, especially for Freddie Fannie, is market, property condition, LTV, DCR, all these things. And so I think, to the point on that being the most efficient capital, if that's going off at 3.25,
okay,
a debt fund is probably going to be higher on the spectrum. But for multi, when I say higher, it's probably 4%. Right. If you have a hotel deal that's unstabilized, that could run you. There's a market for it, but that could run you 7%.
Wow.
So if you think about the multi-housing, the Freddie Fannie nature of them in the market, that is so unique to that multifamily market, and that's why that capital is so efficient from a pricing perspective.
I'm just asking for a lot of the people on here. I think a lot of them are going to be doing value add deals, so they may not be able to get into a Freddie or Fannie if it's a real big lift.
Yeah.
But if the spread between, let's call it an agency loan at 3.25 and a debt fund is 4, I think a lot of people think, oh, a debt fund, it's kind of like an construction loan. It's going to be 5, 6, 7. But if you're at 4, that's if you pencils out, that's very doable.
Yeah. And then kind of in the middle, I would say is banks, because it varies so much. Banks typically are more relationship driven. So, if they have a relationship, especially if it's a smaller bank, they are going to be more aggressive on any one-off opportunity. We still get looped in just because, we can create a market just based on the fact that, we have access to so many different lenders, and we haven't even really discussed life companies, which is, another great lender. They typically want to be lower on the leverage stack because they're life companies. They're matching, their assets, their liabilities with what they're going to be paying out. They're not going to be your most aggressive lender from a leverage, interest only, that type of perspective.
Okay.
I think I think we can start with the stabilizing with the debt fund and graduate into agency loan.
Sorry, do you mind saying that again?
So with the debt funds, you can start with stabilizing a multifamily, and then when this is stabilized, you can graduate to agency fund, right?
Exactly. Yeah, exactly. And maybe just something to think about, but this maybe further down the road, if you're thinking about Freddie Mac specifically, what we see a lot of clients do is go get a floater because of that lockout. Only 1 year, and then it's prepayable with a 1% prepay fee. But if you go get a floater with Freddie and then in a year want to refinance it into a fix, they'll waive that 1%. So there's a bunch of ways to get to where you want to be. But to your point, if it's not going to qualify for the agency's day one, and that's where you take it to a debt fund or a bank that you may have a relationship with, understanding that you're going to get it ready for that agency financing, just because of how accretive it would be to your IRR and your deal level metrics.
Okay.
So this is quick, but this is helpful. What I tried to do here is not tailor it just to Freddie or Fannie or a debt fund, just to give you an idea of what to think about in the financing timeline. It may be a little bit smaller on my screen. So I can make this a little bigger, but I won't go through in the various nodes. But what I want to focus on is, typically where we're getting engaged or a request is coming in is when someone's looking at a deal, right? That's if it's widely marketing, typically we'll get an OM, an offering memorandum, a T12, the rent roll, and then whatever your business plan is. Be able to size that up and say, hey, here's a menu of what your financing options will look like, running the gambit from those lenders, really helping to kind of hone in on, hey, what's the most accretive to my deal. But this is kind of something that if I turn my screen around, you can see it kind of taped up over the office, because just understanding where you are in the deal, very helpful. And then what you think would pop up, and this is typically from, Freddie or Fannie deals, it's typically a 30 is a little bit short. Maybe it's a 60-day timeline. But this is just how we think about that financing piece.
So this is a great slide. It is a little bit hard to see because it's got a lot of detail on it, but would this be something, I think from a timeline perspective, a lot of people panic because they're like, I don't know at what point I have to be at before, my time runs out on my contract.
Sure.
So is this something you would feel comfortable if we kind of sent it out with the emails that people could kind of print out, just this one slide, print out and kind of put above their desk or something like that?
Yeah, I think, yeah. One of the things, maybe what I can do, because I just noticed that, and this is where I'm, really going into this is where my real estate nerd and my job kind of coalesces here, is there's these little start and finish where it says CapForce. So CapForce is our internal CRM system. It's kind of built on Salesforce.
Right.
It is one of the greatest things that you can have access to, because it catalogs all the deals that JLL has done, and it's just a wealth of information. And so, when I really talk about creating that menu, that's where I'm starting to say, hey, who's doing what deal across the country, and what do the metrics look like? So if you think about that, right, especially if it's, local banks or something like that, helps you be a lot more efficient when any one opportunity comes in. Hey, what is the right lender mix for this?
Right. Okay.
Here, I think similarly, this is a good slide to have up. This really goes through how Freddie and Fannie think about it, to the point on the stabilized piece of it. I won't go into detail here, but if you have questions when you review it, feel free to give me a shout, because this is where we spend most of our day, looking at deals. And so it's pretty prescriptive, but there are some things that can help you get more efficient debt. So, I think it's important to understand if you're thinking about what an agency loan looks like and how it gets underwritten from a property level NOI perspective. This more so Freddie Fannie. This touches on I think we spoke on the affordability. One more layer for Freddie and Fannie is they have green efficiency type benefits. Either one, if you're going to go do something that has, low flow toilets, LED lights, if you're going to achieve some energy savings, there's an ability to get some discounts in the mortgage. And then the last bullet focuses on tenant concentrations. I think, from the pinwheel perspective, we kind of hit the layers, but the way the agencies think about it is, market rates different than seniors and student, and also, your affordable deed restricted stuff. And so less so on the affordability, but if you have military or student or seniors, there's going to be some adjustments there on the credit parameters, because they view that as another layer of risk. Military, are they going to deploy? Students, what is the student calendar year? And, what are the threats to that from purpose-built student housing? And then seniors, just, understanding what are the services offered. Because it's not, necessarily traditional multifamily, especially as you go higher up on the acuity scale for, memory care and stuff like that. So less probably helpful for what we're talking about today. I'm gonna stop there because that's really the financing piece. There's a lot of great stuff here that we go through on macro trends and investments. James, what's helpful? You want me to run through this stuff, or you want to do Q&A? Want to make sure I'm mindful of the time.
5 to 7 minutes on what you think is the most important out of the following slides, and then
Sure.
Anybody that hasn't asked questions, wants to ask questions at the end, we'll go ahead and open it up for that.
Okay. Here, this just focus on, multifamily and the long-term things that have really driven the business here. If you think about, what you're seeing from COVID, right? You saw gateway cities. There was a little bit of an exodus that's kind of come back, but also just thinking about, folks that, as we go on, there's a thesis for multifamily because it's harder the purchasing power, in terms of a home with valuations going up and, the threat of interest rates, leaves you with really a strong thesis for multifamily. So we always try to touch on this, especially if, clients are investing across the spectrum. Here, similar slice, just looking at, the various renters' age and also, broken down by their category. I think it's just helpful to understand, who's living in apartments. Similar thing about just, how hard it is, or it's getting harder about, purchasing a home. And so just looking at, there's a supply demand imbalance, prices are up, and then all these other things about, housing starts. It's good anecdotal evidence about why this multi-business does kind of have a longer lens. Same thing. This just goes into markets, which is interesting, because you can see that it's really driven by geography. and something to think about when you're looking at deals. Less important for us kind of in the DMV, but just, with our firm, we have national research. And so it's always helpful for me to understand how it kind of fits into the larger United States.
I'm sorry, that last slide you were just on, what does that mean? Housing affordability prolongs renter tenancy. Obviously, the more value there is or the lower the rent, then the longer the person's going to stay.
Sure. Yeah. So it's a score. Yeah. So it's a score that's, and it's from the, let me see this, National Association of Home Builders, but looking at the various markets, what prices have done, the lending footprint, supply, demand, a few other things. And it's just kind of boiling it down to say market by market, what is the opportunity that, a renter is going to be able to convert into a homeowner? And if you look at the markets, right, the average is 61%, Pittsburgh, Baltimore, Minneapolis, easier. On the other side of the spectrum, you have your Gateway, your San Francisco, LA, et cetera.
Okay, that makes sense.
So this more COVID focused, but it's interesting to just think about these various markets, and really the takeaway is just the top bullet point there. Secondary markets led rental collections during COVID, less so cities that were hit with tourism or higher costs. To me, exactly what you would expect, but interesting to see it on a graph because you can see that there are some value in some of these markets here. Same thing here, but this is just looking at space and suburban versus urban trends here, driven by COVID. One, you saw more concessions, more free rent in some of these, more dense markets, but also really just a gap, people really looking for more space. And so that's what's driving kind of suburban apartments being in cachet. So it's interesting data point. Here, same thing, just looking at affordability, just really helpful when you're looking at markets. But, when we're talking to institutional investors that are across the United States, it's just helpful to kind of plot it and say, hey, these are where you may have an opportunity. This goes back to just the supply, demand, and balance. You do see an uptake here in multifamily, but the other thing is it's sort of trended down in 2022, 2023, 2024. So if you think about what that means, right, less supply that's getting delivered, more chance that you're going to, be able to push your rents on one specific opportunity. Here, just if anything of these slides, I think for our group, important because what it's talking about is, there's a focus. If you think about institutional lens, it's really focused on primary markets. Starting to see folks chasing yield. And, if you think about our type of investors, a lot of you folks are already in these tertiary markets. And so it's interesting that that's kind of where it's headed. And that's really driven by COVID, in my opinion. Last is just, Freddie, Fannie, because that's bread and butter, but just some resources there on those links. Product offerings, but they also are great about, outlaying housing research and different things from their econ group. So, I worked at Freddie, so I always, try to use that as one of the resources that I'm looking at to just be smarter about the markets. And so for you guys, as you're looking at some of these deals, I think it's important to understand, what resources you may have from, the government sponsored enterprise. That's it.
Awesome. That was really great. What kind of questions does anybody have? You can just go ahead and unmute yourself if you want, if that's easier for you.
What is JLL cost in financing these deals? Is it built into this interest rate itself, or origination cost is separated?
So it's separate. Just thinking about Freddie and Fannie for a second. They have prescribed fees, minimum fees. Don't want to go into a huge sales pitch because I'm happy to take you into it, but we charge minimum fees. So whatever the seller servicer guide for Freddie and Fannie mandate based on loan amount, that's what we charge. We don't bury anything into the spread. We don't increase that fee. It's just prescriptive based on the loan amount. So, for stuff that's, I want to say under 10 million, it's 1%. That's the minimum fee that the agency, Freddie, Fannie will let you charge. That's what we'll charge on the deal. And it's a sliding scale based on loan amount. If you think about it though, Freddie, Fannie, more closing costs associated with third-party reports and some legal stuff that are probably going to be higher than if you're going to a local bank or something like that.
So 1% is JLL fee, origination fee?
Correct. And that's prescribed by Freddie, Fannie. They have minimum fees based on the loan amount. So for something under 10 million, it's a point. So it's 1%. And it varies by the loan amount, but if we're looking at something, you'll just get the minimum fee schedule from me to understand what would be charged based on the loan amount. Nothing.
What
more.
about for the debt funds?
So that varies based on the lender. Because if you think about it, we're going to, various lending communities, or lenders in the debt fund space. And that varies by product, loan size, all these different variables, but typically a little more expensive than the agencies because it's prescribed, but that's also kind of dictated by what the opportunity is.
Do you have a range?
Shoot me an email if you don't mind, because it's so prescriptive to the opportunity, but typically a point. And then they also have various fees for extensions, etc.
Got it. Okay.
Any other questions? I have one, but I'm going to hold off until you guys ask your questions.
All right, slides. Where are the slides going to be available?
I'm sorry.
Are the slides going to be available?
Oh, I don't know. Amit, are these slides going to be available?
Yeah. If you don't mind, what I'll do is clean it up a little bit, and I'll send you the deck, and you can feel free to share.
Okay, great. So we'll put a link on there and we'll upload it to the cloud. So when you guys get the email, you'll have a link to the video, and then you'll have a link to the deck once it's edited.
Awesome.
So when do you usually ask to engage JLL? Basically, once you have an LOI accepted?
Before we bird dog so much business, and it varies by opportunity. LOI is fine, but if you need help prior to, feel free, because we view it as just another opportunity to show you what we can do. If you don't win the deal, it's an acquisition, that's totally okay, because it'll help you for the next one, right?
Right. Okay.
But LOI, to your point, is where we would typically go formally into the lenders. But with that being said, we have so many data points that I can generally tell you where it's going to land without having to do that.
Okay. Do you have your contact information shared here in this deck, or maybe you'll do it later? Right?
I'll add it in. It wasn't in here, but yeah, I can add it in, or James, you can share whatever works.
Absolutely. So we'll send it out with, and if you want to put it in the chat right now, someone wants to cut and paste it.
Sure. So if you see my name, it's Amit.Kakar at am.jll.com. Now let me see if I can figure out how to put that in the chat on Zoom. Let's see. I have no idea.
All right, so wait a minute, I'll type it in. So Amit.Kakar.
Sorry, at am.jll.com.
I just added your JLL profile link in the chat. So it has everything, information there.
Oh, there you go. Thanks, Amit. That's awesome.
Yeah.
Oh, here, yeah. Okay, perfect. Yeah, and you can find me on LinkedIn too.
So my question was, during COVID, it seemed like a lot of the lenders were asking for bigger deposits, right? We want 6 months worth of taxes, or we want 12 months worth of principal and interest, and obviously when these guys and myself included, when we underwrite a property, it really affects our return the more money we have to bring to the table, right? So it's money that's sitting there we can't touch, and yet we're paying interest on it.
Sure.
So has that changed drastically? What kind of reserves are banks or Fannie Mae and Freddie Mac, what are they asking for? Do you bring to the table?
Sure. So the one variable, I would say banks and debt funds, just because of how unique that is to who the lender is in those two kind of nodes, if you will. Freddie and Fannie, though, they started, with prescriptive COVID debt service escrows. Fannie, I think, was 12 months at max leverage. So if you're getting an 80% LTV mortgage, they were charging 12 months P&I, and then Freddie was doing 9 months P&I. Over time, that went to interest only, so calculating on an IO basis. Then they trimmed it down to 6 months, and so sliding scale. As of last week, they've gotten rid of their COVID escrows. So
Wow.
it doesn't mean that they're not still asking about age receivables, et cetera. Or if there's a deal that's already closed, you're not giving those back until you're, free of whatever their guidelines are.
Right.
But on a go forward basis, unless there's, a hiccup, they've eliminated those. So that's helpful. With that being said, they're still asking about age receivables, and so that could get more questions, but kind of off the rack. Less of a concern for Freddie Fannie.
Okay, great. That's good to know.
Do you get any discount points because of opportunity zone investments?
Not from Freddie Fannie, because that's something that I think they're more focused on the in-place affordability for the rent roll. And that's just a function of, what they say they have to do in terms of affordable housing goals, in my opinion, but not something where there's a queue or an opportunity zone type discount.
Got it.
Anybody else? Any more questions? Going once, going twice. Okay, well, Amit, thank you so much. I know you got a lot going on. You're still at the office, so I appreciate you're taking time out of your busy day to share with everybody.
Always happy to talk about this. So, my pleasure. Thanks for the opportunity.
All right, great. So what we'll do is, like we said to everybody, we'll get this out probably by Monday. We have to break it down, edit it, and make it look all pretty before we send it out. You've got Amit's information there. If you guys need anything from me, my email, as a lot of you know, is james@passivecashflowforlife.com. Otherwise, again, a lot of thank you here's Amit. Kevin says thank you. Jerome says thank you. A lot of people are saying thank you. So
My pleasure.
And I will talk to you guys soon. Everyone stay safe out there.